Welcome back. Eight minutes away from the CPI. Let's take a look at futures here. Dow Industrial's up 59 points, fractional move, and NASDAQ higher by 3. The S&P up 3 3/4 points. The March CPI report is out in about 8 minutes. Economists are expecting the CPI to be up 0.2% month over month and up 5.2% year over year. We'll also get the March Producer Price Index out tomorrow. Joining us right now is Thornburg Investment Management President and CEO Jason Brady. Jason, great to see you. Thanks for being here.
It's a pleasure.
How do you see inflation moving? What do you think about this CPI, given the fact that oil prices are now back up to $81 on crude?
Well, oil prices are back up now, but when you look at core and headline, what you're going to see from the headline numbers is, for the first time in a while, headline being lower than core because energy prices broadly came down during the measurement period, particularly gas prices. So that's going to be a major shift, and I'm really looking for what's going to happen with services. That's the big question.
So what do you look at in terms of the CPI that's most important? What metrics are you going to be studying?
The key pieces here are goods. Goods has passed the baton to services as far as what's driving inflation. So goods prices are down around 1%, but services inflation are up around 6%. As we look at that going forward, the real question is, how strong are wages likely to be? We got a little bit weaker report on Friday from the jobs report around our average hourly wages. But really, how sticky will services inflation be, and therefore, what is the dynamic of a potential wage price spike?
Yeah, it's true, because for a while we were spending money on stuff, right,
Yep.
James? And then, once people got out of COVID, they started spending money on services, and prices went higher.
Yeah, and I'm kind of wondering what you see here in terms of, I think there's obviously a big appetite on Wall Street to have the Fed end its tightening. They're thinking if we get a lower inflation number this month, and looking at the recent bank troubles, maybe that's the end of it. But you look at that Fed balance sheet, much bigger after COVID. It came down a little bit, and then it started heading back up recently in response to the bank trouble.
Right.
Doesn't that suggest there's a lot more money that needs to be taken out of the system?
I think that we're in the process of normalizing. And really, the story of 2022, particularly in the markets, was normalizing towards real rates that are positive versus what they've been for a long time, which is negative. That's not a normal situation. The problem is the speed limit for rates in the economy may be different than the speed limit for rates in the financial system. And that dynamic is extremely complex. Ultimately, the Fed believes they have the tools to handle the financial system that are separate from the economy, but there's quite a lot of interplay there.
Well, we've seen what higher rates have done to some companies. I mean, Silicon Valley Bank and Signature Bank were major events in the quarter, but some of the banks are kicking off their earnings period this Friday. We've got JP Morgan, Wells Fargo, Citigroup all reporting before the opening bell. Treasury Secretary Janet Yellen is downplaying the recent banking crisis. She did this yesterday. Watch this.
The U.S. banking system remains sound, with strong capital and liquidity positions. The global financial system also remains resilient due to the significant reforms that nations took after the financial crisis. We're committed to continuing this work through bodies like the Financial Stability Board and the Basel Committee on Banking Supervision.
Your reaction, do you agree?
I think that if the Treasury Secretary came out and said the banking system was not resilient, we'd have a serious problem. So there's really, of course, she'll say that. I'm interested in what the IMF came out with regard to longer-term projections on the global economy, which are quite negative. And I also think we're going to get minutes later today as well. So the Fed deliberated around the last rate increase around the same time of the banking crisis, and we'll see what they thought about that. I think that'll be much more interesting than sort of a headline from the Treasury
market
Secretary.
Participants were confused by Janet Yellen initially in the middle of the collapse of Silicon Valley Bank, because first she said, oh, we're going to move to support all deposits. That's $18 trillion. Then she said, no, we can't secure all deposits. We're going to have to make choices in terms of who to support. So what are your thoughts on the banking sector?
Kind of went back and forth, and I think part of it was they were trying to address the problem created in Washington of too big to fail banks. If once they enshrine that, do they then have to worry about money flowing to them from the others? But not to appeal to the authority of Janet Yellen or the Bank for International Settlements or any of these organizations, but do you think the banking system is fundamentally healthy? Do you And related to that, do you see a real credit contraction since Silicon Valley and Signature blew up, or do you look at those as kind of one-off events with their own problems and not necessarily a larger problem?
I think that the banking system has the problem that the banking system always has, which is it's a leveraged way of doing business, right? They borrow short and lend long. That said, I don't think this is a 2008 scenario where we have a systematic banking crisis. I think Silicon Valley Bank tells a much more interesting story about the tech and private capital ecosystem than it does about the banking.
Biotech too.
Exactly.
Yeah, let me just say that Stephanie Pomboy from MacroMavens was just with us a few minutes ago, and this is her worry. She says she's worried less about inflation because it's coming down. She's worried more about the banking sector, and that has her making some serious predictions about a sell-off in stocks. Watch this.
I think actually we're overvalued by the standard stock market cap to GDP by $20 trillion. So that's roughly a 50% haircut. And I think we're at the beginning stages of a credit bust that I believe could look a lot like 2008, 2009 in magnitude.
What about that credit bust, Jason? $1 trillion in corporate debt rolls over this year. This is why she's worried. She says some of those companies won't be able to afford the higher rates.
I think that there's always going to be companies that are over-levered. If you want a vector for real challenges that it looks like 2008, I'm not so much worried about a broad corporate sector, or particularly very large companies. They're not tremendously levered. What you might look at, and there's been a lot of headlines around this recently, is commercial real estate. Commercial real estate is about 75% of the size of the residential real estate market, so not as big, but pretty much a similar scale. And looking around New York, there's a lot of vacancy.
We were talking about this. I'm wondering if commercial real estate is going to be sort of the trigger that takes this economy into recession. Federal Reserve officials are now divided over whether to hike interest rates again in May. The next meeting is May 3rd. New York Fed President John Williams says that one more hike is needed to bring down inflation. Chicago Fed President Austin Goolsbee said we need to call for a more cautious approach. So how important is today's number to the Fed's decision making?
It's critically important to the Fed's decision-making, particularly in May. But looking forward 6 months or a year, whether they go 25 basis points or not is frankly irrelevant. The question is, how long are they going to be able to stay at these levels? History would suggest that the Fed doesn't get that rate right very often.
Yeah.
It's hard. They're looking in the rearview mirror. I mean, inflation and unemployment are things that are lagging indicators. Leading indicators do point to something of a downturn.
Well, let's face it. We were at 0 for 15 years, and then we went to 5% in 11 months, James.
Yeah, it's never going to be easy cleaning up the mess they made, continuing to print money after the economy started rebounding in the middle of 2020. So, the idea that we would do that bizarre, unprecedented experiment and there wouldn't be a difficulty landing the airplane later, I think that's the leap of faith.
We're waiting on the March breaking news. March